Guys, I'm excited tonight because we got a lot of talk. We got a lot to cover. Hopefully I can get honestly, all of these different strategies. I'm going to share with you guys tonight, 3 different price action strategies that I use almost every single day in the market. I'm really excited to share this with you. However, we got a lot to cover because each one of these three strategies could take at least an hour to cover. And if you've ever been to like a price action boot camp, we do. We go into each one of these strategies and we spend an hour. So I'm going to try and just give you guys the highlights for sure. At the end, we'll have some questions and we'll do a few cool Q&A if we have some time. But I'd like to really just get through all of the material as quickly as possible. But I also want you guys to understand it. So if I'm going too fast, just let me know. But again, price action trading is hands down my favorite way to trade. And the beautiful thing about price action trading is that you can do it in currencies, you can do it in stocks, you can do it in options, you can do it in crypto, you can do it in S&P, you can do it in anything because it's all about supply and demand, right? And so anything that moves with price, you can use these strategies in. And so that's honestly one of my favorite things about price action. Real quick, these are kind of the things that we're going to go over tonight. We're going to talk just briefly about, what is trade the fund? What the heck does that mean? What does trade the fund mean? We're going to talk a little bit about the 5 to 50 challenge, and then we're going to jump into the strategies. We can't understand what the strategies are if we don't understand price and we don't understand time cycles. We're going to talk about the first pullback strategy that I use. We're going to talk about false breaks. We're going to talk about Fibonacci so that whenever I say in our trading session, oh, you should fib that, you know exactly what I'm talking about. Then we're going to go over and teach you guys how to trade with confidence so that you back test each one of these strategies, or show you how to back test a strategy or a technique that maybe you are thinking about trying and incorporating that into your own trading. And then lastly, if you like what you have, if you like what you see here, we're going to invite you to trade with us. We trade every single day. Let's get started. What is Trade the Fund, right? Trade the Fund is just a market trading agency based in Linden, Utah. The whole purpose of Trade the Fund is to help you guys get into a funded account. And we have multiple ways to get into a funded account. We have the 5 to 50K challenge, which we'll cover here in just a minute. Basically, it's where you grow your account and then you keep the profits. So you grow a live account and keep the profits. Then we have trading leagues, which is you get to learn through competition. Oh yeah, and by the way, once you graduate trading leagues or you play in the top league, you also can get invited to manage money, manage a prop firm account, right? And then trading challenge. Right. We have what we call like the apiary trading challenge, which is a great way for traders that, hey, you're already a good trader, you know how to trade, pass the challenge, get a funded account, right? But all of this is just kind of incorporated into Trade the Fund. So you choose the path, you choose the way, and let's get going, right? All right, just kind of a little bit about me. I'm going to give you guys a little bit of background on who I am. My name is Dave Moffitt. I'm from Utah. Been trading since about 2009, and I trade every single day. I absolutely love it, hands down. Father of 3, my kids actually, 2 of my kids actually work for me. They're the ones that are helping me put all the technology together. And I love it. Love working every day with my kids. And I love teaching and seeing people get those aha moments, right? And, obviously I'm missing one of the most important things is that I've been married since 1999 to my beautiful wife. And she is honestly a great support in my life and a great mother and great wife. Couldn't do this without her, that's for sure. All right. So enough about me. Let's jump in. I love this quote. There is only one side to the market, and it's not the bull side. It's not the spare side, but it's the right side. And so the more times that we can be on the right side of the market, obviously we're going to get that consistency. We're going to get, we're going to be able to grow our accounts. And that's the name of the game is, doesn't matter what strategy, what technique, what market you trade in. All that matters is that, all that matters is that you're making money and you're consistent with it. All right. So let me talk real briefly about what the 5 to 50 challenge is. Basically, we trade every single day in the market, Monday through Friday, for 2 hours a day, from 7 a.m. Mountain Time to 9 p.m. Mountain Time. We trade. When we hit our goal, we do practice, and then when we practice, we kind of do a trade review. We review that every single day. The goal is to help everybody that is trading with us become a better, consistent traders. I mean, our key here is that we develop successful traders and empower them with the tools and knowledge they need to make successful market decisions, like what we're going to cover tonight. So we give everybody a $5,000 account, and we grow that into a $50,000 account. And then at the end of the $50,000 account, then you can start pulling profits from that $50,000 account, and you've grown it yourself. And now you start reaping the rewards. And along the way, you're also eligible for a fund increase. Every 90 days, you get a fund increase all the way up to $250,000. Now let's jump into price and time cycles here really quick. So one of the things that I've been kind of scouring the internet to see what kind of content is out there. And I've been looking at a lot of price action content because honestly, that's the way I trade. And everybody has their own style or methodology and how they teach it. But the thing that I was honestly astonished at is that everybody he teaches you price action trading, but they fail to teach price and time cycles. Like, I go to YouTube and I type in price and time cycles, and it's like it's non-existent. That piece is non-existent. People don't teach it. But in my mind, time cycles is the most powerful piece that starts the whole chain of everything that you do. Right. And so if you don't understand price and time cycles, how are you going to be able to trade price action trading? And I'm sure that people understand it, but maybe they think that it's so basic. You're experienced traders. Maybe it's the only explanation that I can have is that they think it's so basic that everybody should understand it. Well, the thing is that I've come to learn that most people don't understand what price and time cycles is. It does not matter if you're a scalper trader, a position trader, a day trader. It doesn't matter how you trade. You need to understand price and time cycles. So let's go over that for a second. Right. I mean, I added this one. I talk about this, has this ever happened to you guys where after you find the trend or you market bias, you found that it's difficult to still make money because your timing was off by maybe a pip or two, or just barely almost hits your take profit and then goes completely the other way. Well, if that's happened to you, then you need to understand price and time cycles. Right? By understanding price and time cycles, we can properly place our take profits, our stop losses, and everything in between to help us to become a more profitable trader. All right. So price and time cycle rules. So every single strategy, and this isn't necessarily a strategy, but it's the foundation upon which all price action strategies are built on. So you still have a little bit of rules here with the price and time cycles. And you guys have probably heard me say this over and over and over, who's with us tonight, but I want to talk to maybe the people who are just getting started, maybe just understanding what price action trading is all about. So we're going to start at the basics just to make sure that we lift everybody to the same level by the end of this presentation. All right. So the first rule of price and time cycle is you always go back to previous consolidation to get your price cycles. Once consolidation happens, it usually comes out the other side of consolidation with new price cycles. So if you're going to measure your price cycles, you always measure, you go back to where you're at in the market today, all the way back to the previous consolidation. And we'll explain that in a second. So what I'd like to do, kind of the format of the strategy, is we're going to talk about the rules, then I'm going to show you what I mean. And then we're going to jump over to the market to actually look at a few examples. Okay. I'm not going to cherry pick market conditions. We're actually going to dive into live market conditions because I really feel like that's what you have to do every single day. Is whatever the market conditions are, is the market that you have. I often say, don't trade the market that you want, trade the market that you got. Right. And so adapt and change and overcome to the market conditions. And that to me is one of the most difficult things as a trader, trading anything, is to be able to adapt to the current market conditions that you're in, to be able to recognize the market conditions so that you can change your trading style a little bit to conform to what market conditions you're in, right? Not one way is going to work for you every single day. Now, your strategy, your technique should be the same, but you need to adjust maybe your position size, maybe your price cycles are a little bit different. You need to figure out what type of market that you're in, a trending market, consolidating market, a breakout market, all these type of things, and then pull the technique or strategy out that is going to suit the market structure the best, right? All right. So first rule of price and time cycle. You always go back to the previous consolidation to get your price cycles. Then once you understand what the price cycles are, you need to set your position size correctly for the type of cycle. Again, I don't care what time frame you're trading. This is true for any time frame. Personally, I'm a scalper trader. I scalp the 1 minute and the 5 minute. And so we're going to do a lot of our examples on that. So if you guys happen to be watching this and you want to learn how to scalp, or you are a scalper, this is going to be an excellent training for you. But price action at any time frame, the rules are the same. Okay. And don't go for 100% take profit of the price cycle. And my rule of thumb is I usually go for about a third, maybe half. If I'm in the same direction as the trend, I might go a little bit more. If I'm counter trend trading, I might go just a little bit less. But I always want to make sure that I get that take profit, right? To me, it's more important of getting that take profit, of hitting that take profit, than it is of maximizing my take profit, right? Of course, we want to maximize our profits, but we also want to do it smartly, and we'll explain that in just a minute when we go back over to the charts. All right. So, and then you have to know when price cycles change, right? If you're trading in the morning time, price cycles change all the time. I mean, they can go from periods of 10 to 20 back to 5. You got to know, and you got to understand, you got to make the proper adjustments when price cycles change. Now, they're going to change a lot quicker, obviously, when you're scalping than when you're position trading. So, and then you need to understand the 3 price cycle rule. Okay. And I'm going to jump right over that, and I'm going to explain what that 3 price cycle rule is, because the best way to explain it is actually to show it. So when we measure out price cycles, the market usually, I'm going to just fatten that up real fast. The market usually, as we know, or we should know at this point, if we're trading, we know that the market usually runs in periods of expansion, consolidation, and then expansion. And what we don't know is we don't know if it's going to get an expansion this way or if it's going to expand that way. But we do know that market always goes in expansion, consolidation, and then expansion, right? And so if we know that we're looking for the next consolidation or the next expansion. Okay. And the markets rarely ever expand and trade in a V, right? They rarely ever trade like this. And so, normal market conditions trade something like this, right? And this is what you typically get in a market. And I'm just drawing that, excuse my artistic skills. I am a much better trader than I am an artist. That's for sure. All right. So, on here real quick, what we're looking for when we measure out a price cycle is the period of time that it takes for the market to move down and then back up and then back down and then back up, back down, back up, and then back down, right? The market generally moves in one price cycle. Generally, probably I would say between 40 to probably 50% of the time, you're generally moving. And let me break that down. Probably about 30 to 40, I would say 30 to 40% of the time, it moves in one price cycle. It moves in two price cycles, probably 40, probably maybe 20 to 30% of the time. It moves in three price cycles, probably about maybe 10 to 15 or even 20, 10 to 15% of the time. And then it moves in 4+ price cycles, 0 to 10% of the time. We'll explain what that means. So the rule of three, back to the rule of the understanding the three price cycles, is that if the market moves against you 1, 2, and 3 price cycles, you usually get into what we call an overextended market, or overbought, oversold. A lot of times people will say that. And so the probability for it to move one price cycle back, at least one price cycle back, becomes really, really great. And so by knowing the rule of three, you know that, hey, it's just moved against me 3 price cycles, I can probably be more confident in placing a buy right here, because I understand that the market has just moved 3 price cycles down. So the chances of it moving at least one price cycle is really high. And if it goes down again, it just gets more, the probability becomes more in its favor of going back at least another price cycle, if not 2 price cycles back the other way. So that's kind of the rule of three. So by understanding that the market typically moves in one price cycle up, one price cycle down, one price cycle up, one price cycle down, that's typical to the market. And then you get a double move, one up, double move, one up, and then maybe 3 price cycles up. And so by knowing that, you can kind of time your entries and your exits just a little bit better. All right. So now let's just go to the market real fast, and let's take a look at exactly what I mean and how to measure your price and time cycles. All right. Let's see. Can everybody see Alveo? Okay. So the first thing you have to do, and this is what I always see, you're not seeing Alveo. Thank you. Let me stop share real quick and share my screen. Now you guys should be seeing Alveo, right? All right, perfect. All right. So I wanted to kind of, I did place this market right here and for a reason. So before I get in and actually show you guys how to measure price and time cycles, I always tell my students, the people that are learning to trade, to do the 1, 2, 3s before you ever place a trade in the market. The 1, 2, 3s. 1, you identify trend. 2, you determine what the market bias is. Right? Sometimes the trend and the bias are just not the same thing. And then 3, you look for what your price cycles are. You identify your price cycles. So you got the 1, 2, and 3. All right. So if I were to ask you right here, and I see this happen all the time. If I were to ask you guys right out of the gate, and in fact, I'm going to ask you guys who are on here tonight, what is, looking at the market right here, what direction is trend? What is trend right now? Where's my applications? Why are you over there? Get over here. All right. So good. You guys are saying down. Great. It's down, right? But I often see traders do this a lot. And so this is why it's important that if you are, a scalping trader, or that you are a position trader, obviously it's down in the trend that we're looking at. But guess what? If I were to widen this view out, right here, and we're going to trade this, now what is the direction of the market? Exactly. It's up, right? But you could say that it's up, but right here, you could say it's a down. Now, this is a perfect market right here. And this is today's market. This is a perfect market to go over everything that all three strategies that we're going to talk about today happened in this market, and it happens every day. So sometimes we get caught because we're like, oh, you know what? Sometimes we get caught. And if this is where we're entering the market, so let's say that this is where we're entering the market to trade today, we could be looking at, well, trend is down, but is that the bias of the market? You know, trend could be down for a short-term trend, but that's not necessarily the market bias. And so I wanted to throw that out there because obviously the market bias is in a uptrend, but you're in a current downtrend, right? And so how you look at price and time cycles is really, really easy. And so when you come in here, most of your MT4 trading platforms have what we call a crosshairs. And inside the trading platform that I personally enjoy and love called Alveo, it's right here. This is where your crosshairs are. And also a quick hot tip is just your middle mouse button. Use it all the time. So if we come in here and let's say that we're about to trade, and this is the market that we're looking at trading in, well, we identify where was the last consolidation. Well, the last consolidation pattern or the last consolidation happened right in here. So coming outside of consolidation, what are our price cycles now? And so what you would do is you would come here and when you'd say, okay, our price cycle is up 11. Now it's important to also note that it went up 11 and we're measuring from the body to the body. Okay. So from the bottom body to the top body, it's up 11 and in 4 bars. Okay. A bar represents a minute or whatever time frame that you're on. Over here, a bar represents 5 minutes because you're on the 5-minute chart. So right here, you go up, it moved up 11, 4, and then it came down 9 in 3 minutes. Okay. Moved up 7 in 5, moved down 5 in, in 1, 2 right there. And then you kind of measure right here. So what I would do is I'd say, okay, I would probably take this move as a 2 price cycle up move and go, okay, it moved 2 price cycles. You see that right there where it moved 2 price cycles. Right here would be a price cycle. Then it kind of pulled back and then moved back up another price cycle. So I'd say that would be a 2 price cycle move. And then this, and this is probably the best way to show it actually. I love doing this with Alveo. So we take this little line right here. This is a price cycle. That's a price cycle. This is a price cycle. This is a price cycle. This is 2 price cycles right here coming out, another price cycle, and then you have 2 price cycles. I love doing this. We're going to do this a couple more out here. Here's 1 price cycle. Here's 2, another price cycle. And then this is a larger price cycle. All right. So now that we have that, let's take these bars up here real quick. So we're going to put them in. These are all price cycles right here. You guys start seeing a pattern. And this is pretty interesting. I love doing this. Right here. This is 1 price cycle. So we just measured 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So out of 11 price cycles, the market moved, or let's just say out of 10, the market moved 1 price cycle, 1, 2, 3, 4, 5, 6, 70% of the time it moved 2 price cycles, 1, 2, 3 out of 10 price cycles. And it's so interesting to me to think that if you take this right here, put it there, and then this one right here and put it there, Isn't that interesting? That the market is moving at the same, it's almost identical. One price cycle, two price cycles, right? And you can do the same thing. One price cycle here, there's a price cycle. And then here is another price cycle. Isn't it interesting that that is exactly two price cycles? It's almost exactly two price cycles. And so if we know that the market tends to run one price cycle or two price cycles, and then probably right here, like we said, we get a third, probably three price cycles, right? The market tends to run in price cycles. And so we know that what we just talked about is we know that the market is in three price cycles. The chances at the end of three price cycles is really high that it's going to pull back and at least give us one price cycle before a continuation, right? We can start building into sells right here for the end of the price cycle. Then we also know where to put our take profits, where to put our stop losses, right? And our take profits. So if we start putting into sells right here, and we know that our price cycles are, I think we said 5 to 7, we know that we would go down here and we would not necessarily take 5. Remember, we're not really going for 5 pips. Again, we're scalping. So back to the scalping strategy. We're not looking for 5 pips of profit because we don't want to go for 100%, particularly if the market isn't an uptrend, right? And if the market's in an uptrend, we want to go less than 50%. So here you could stack in for a 2 or 3 pip profit, right? And here, right here, and then once we'll cover that in a second with the other things, but once you identify that, hey, it's at the end of its price cycle and it should turn the other way, if you're into the buying trend, if you're with the trend, and you know that it's going to run about 6, so now we could go for maybe 50% and pick up three or 4 pips, right? And this is just interesting to note that price cycles, and to me, like, why isn't it more common out there? Why are people not talking about it? Because to me, it's the foundation of where I built of what I do, right? It's particularly when you're scalping. And I love showing things on the 1-minute chart when I'm teaching, but you can do the exact same thing on the 5-minute chart, the 1-hour chart. It doesn't matter. Price cycles are price cycles. And so one thing that you want to do is when you get into trades, if we're going to get into a trade, we're going to get into a trade right here. We'll zoom in. If we were to get into a trade right here, we would wait for confirmation of the turn. Once, and this is the other thing that I'm going to just change my color here to red so you can see that a little easier. This is the other thing that I talk about real quick. I call these action points, and I'm gonna use that terminology. Like I said, everybody teaches basically the same principles, but they have a different way of teaching, right? If you were to play on one basketball team and another basketball team, you're still playing the same game of basketball, but one coach has completely different terminology than the other. And so I'm just saying action points. And the reason why I call them action points is because it's derived from price. Everything is derived from price. So price action, right? So price action points. The action points that I talk about are things where you as a trader need to decide to take action. And there's only really 3 things that you have to decide on an action point. 1, do I enter my trade? 2, do I exit my trade? Or 3, do I hold my trades? Or do I, kind of sit on my hands? Is this area where I sit on my hands? Okay. So now we have kind of identified what I call an action point. I'm going to use that terminology throughout. And so I'm just kind of wanted to just explain that so that I can continue to draw back on it. So right here, it says that this is my confirmation that we're into another price cycle. We got a price cycle move higher because this candle is a reversal candle, right? Because it broke higher, or the body closed higher than this candle, meaning that it's a good indication that we're into another price cycle. So if we're into another price cycle, this is where you could start to enter into buys. And then what you would do is you would come up to your next action point. Now you got to widen this out. You need to widen this out to find out where our next action point is. So the next action point is basically where you find support and resistance. So we're into buys right here. And I would say that this is our next action point right here on this resistance. And so the action point says that if it comes up into this area and it stalls, you want to get out of your trades, right? And so we would set our take profits. If we're going to set take profits, we want to set our take profits right underneath the action point. So we don't want it to have to cross. We do not want our take profits on the top side of this body. We want it right below the body, so right into here, and that's where we want our take profits. Meaning, if you think about it as support and resistance, you do not want, if you think about it as a wall that the market has to break through, you don't want your take profits on this side of the wall and saying, okay, market, you got to break through. And I guarantee you that a lot of times, if you're finding that your trades are going up and missing your take profit by just that much, it's because you don't understand price and time cycles, right? And so by placing your take profits just a little bit below the body of the candle close, now we're taking that wall and we're saying we want our take profits before it has to break through that wall. Right. And that's where you place your take profits. And so just that little tip alone might help a ton of you traders out there that I see often that are like, it is so close to my take profit. It doesn't hit it, turns around and goes the other way. Right. Well, that's one thing. That's one thing is like, and then the next thing that I tell traders is, why does it have to hit your take profit? Why don't you just hit the X and take it yourself? Right. And then they like, hey, you're right. But a lot of times, if we're not watching or we're not watching our trades, we want to make sure that it hits our take profits more times than it doesn't. And so by just doing that, by placing your take profits below that imaginary wall or resistance or support or whatever, you'll start gobbling up more profits just by the proper placement of your take profits, right? So the other thing that I love about price and time cycles is that generally how long it should take before it hits your take profits, right? And as a rule of thumb, if price is moving, for example's sake, let's say price is moving 10 pips in 10 minutes, and and this is a range, so you never say 10, you go 8 to 10, and then 8 to 10 here. That is moves up one price cycle in 10 minutes and down one price cycle in 8 minutes, right? Or something like that. And so that. So by knowing that, that if you are in a 2 price cycle move, well, then you're probably going to have to wait 18 to 20 minutes before it comes back, before it comes back to down to either get you out with profit or help to mitigate your exposure in the market, right? So the other thing we talked about is by knowing price and time cycles, you can know what your proper position sizing is. So if you have a price cycle of 10, and we've had this lately, we've had greater than 10 price cycles, maybe we've had 20 price cycles. If you're in a 20 price cycle move, you better not be trading the same position size that you trade at an 8 to 10 price cycle move, because you have to withstand sometimes you have to withstand 3 price cycles in a losing trade. And then before you get a price cycle back down, before it starts coming back down. And so if you have to withstand 20 pip price cycles, that could be 20, 40, 60 pips that you have to withstand a run against you before it comes back. And so you better be trading with the proper position size. And we're not going to go over that tonight. We're not going to talk about position size. That's a whole other hour-long conversation. But price time cycles is the foundation of which everything is predicated upon, right? And so that's why I'm spending a little bit more time on this, because it's their foundation. No matter what time frame you're trading, you need to understand price and time cycles. Okay. All right, let me just, my dog is going crazy. I apologize. So isn't that interesting though? I mean, if you take that and measure out their price cycles, it's so interesting to me to see like that's how it works. That is exactly how it works. All right. The other thing, I didn't put this down as a rule, but this is definitely a rule that you never, ever, ever place a trade in the same direction at the end of a price cycle. So end of a price cycle, never place a trade. So basically right here, if you're seeing that it's gone up 1, 2, 3 price cycles, you do not put a buy here. I mean, that's common sense, but you don't put a buy, right? So again, if this is at the end of a price cycle, you don't put a sell here. So you never place a trade at the end of the price cycle. So when you start identifying where my price cycles are at, you don't buy here and you don't sell here, right? And that's kind of the unwritten rule, is you never place a trade at the end of the price cycle. Now I will say this, so there are exceptions to every single rule out there, but if you're just getting started, if you're a new trader, focus on the rules before you start learning the exceptions. One of the things that I say often and always is the market can be the best teacher and it can also be the worst teacher. And what I mean by that is that you could do something completely wrong in the market and win, because the market is doing something that it doesn't typically do, or not a high percentage of the time. And so that just reinforces bad behavior. And so if you don't understand what bad behavior is and you win on it, then you can be like, oh, well, I did it last time and I was good, but now I can't do it again. I can't seem to win on this. And so the market can be a really great teacher and it can be a horrible teacher at the same time, right? And so don't trust the market to teach you. Learn the principles of price action, and then you're going to win more than you lose. But the key is more than you lose. You're still going to lose, right? You're going to have days where you lose, but the key is winning more than you lose, right? And then the next evolution as a trader is to control your losses, manage your losses, and fix your losses, which we're not going to talk about tonight, because it's, again, a whole other conversation about how to fix and manage your losses. All right. So let's get back to the presentation. Can you guys see the presentation here? I like that, Drew. You sound like a doctor. You don't want to reinforce bad behavior. Absolutely. All right. Thanks. I appreciate it, Joseph. All right. Let's jump over it. So one of the first strategies that I want to talk about and go over, it obviously has to do with all these strategies have to do with price action. It's the first pullback, right? So the first pullback of a breakout. So you get a breakout and you get that first pullback, right? And we kind of went over it this morning in our trading session. So those of you guys who were in that trading session is just going to get a double dose of it, because it was an awesome education experience in the trading session this morning. All right. So the first pullback rules. One is you got to identify the trend, right? I mean, that's common sense, but it's still there because we're talking to everybody with different experience levels. And so we want to just make sure we start at the basics. Identify the trend that's relevant to whatever time frame that you're trading on, right? And then trade in the direction of it. I mean, that's it, right? And then you need to be able to classify what type of trend this is. So is it a strong trend? Is it a Is it a vertical trend? Is it a straight up trend? Is it been the slowly building trend? Is it what we call a marching market where, it's not getting you those price cycles? It's just kind of slowly building up, building up. You need to identify what type of trend that you're in, right? Or is it a, breakout? And is it just going straight up, right? Or straight down. So identifying the type of trend that is, and then know where your action points are. And we'll go back and we'll kind of reaffirm that, what the action points. So know where your action points are before you jump in. And then obviously with every single one of these strategies, it's not a lot of people talk about this when they're talking about this is the best strategy that I use. They never talk about when your strategy fails or when you shouldn't use that type of strategy, because you have to understand market conditions and before you can understand, is this strategy a good one to use? A good trader, a professional trader will tend to usually have 2, maybe 3, maybe even 4 strategies that they can pull that they're comfortable with deploying depending on the market conditions. And by knowing the weak points of each strategies and the strengths and the weaknesses is equally important as knowing how they are and how to execute them. Right. And so by knowing when this, when the first pullback strategy fails is just as important as knowing how to properly execute it. All right. So this is the first pullback strategy. So we're just going to look at this outside of a breakout. We talked a little bit about, period of expansion, contraction, and then back into expansion again. Right. And so this is not a strategy, but I'm going to give you guys a little bonus tip here real fast. On a breakout, depending on the action of this candle. So if this is a 1 candle shoot up, so if it's a 1 candle shooting straight up, so you got kind of prices like this and like this, I think I'm going to tell you 1 candle straight up right here, and it fails to break this point. It fails to break that point, which is our action point in the market. And you have profit between here and a retest of this. This is not, again, this is not a strategy, but a technique. So I want to just make sure that that's clear. This is one of my favorite techniques, or my favorite quick hits to get, is a retest of that support that's now resistance. So a retest of this resistance often comes on a 1 candle break to the top, fails. I will smack the sell button right here as many times as I can, or whatever, get in as quickly as I can for a retest of this. And this is what I call a high probability trade setup that I take. And it's one of my favorite ones at all times. And it comes when you're looking for the first pullback. Right? Because technically this is the first pullback as well. And so you can get in here and you can double your profit making machine and just gobble up all those profits by smacking those sells, get out right here, and smacking the buys if it fails to break lower and stalls right here on your action points. And then get into buys right here, and then ride the trend up to whatever point this is, right? And your take profits, again, are set below right here, and that's where your take profits are. I don't know if you guys can see that. Maybe I should have made it a little bigger. That's really tiny. But you get the point, right? Again, back to making sure that our take profits are below that action point. But you can buy in right here and gobble up all these profits for it to come up to those action points. So that is the first pullback strategy, is that you wait for consolidation, then a breakout either direction, and then you wait for it to pull back. Coincidentally, a lot of times, depending on how many candles it took on this full pullback, a lot of times I look for that 50% fell or pass. So it's a pass or fell right here. I know I'm probably taking you guys back to your school days. Is it going to pass or fail right here? So I look for a 50%. If on the first pullback strategy, I look for a 50% pass or fail. If it passes the 50%, it's probably going to go 100%. And this is not, again, this is like really quick on the 1 minute chart or the 5 minute chart. It's not a price cycle where it takes 5 to 10 minutes, right? It's on the next 1 to 2 candles. So I usually play the 1 minute. And so it's a quick setup, right? It's a really quick setup. If it fails to pass the 50% mark, then that's when you get in for buys right here on the 50% that's your first retracement, right? And so let's go ahead and look at that over in the charts really quick. All right, so let's find this real quick. So here we are. We got we're gonna just fast forward into these charts for some consolidation. Here's some consolidation right here, and then we have let's see where our breakout is right here. All right, so here is our breakout, right? So you got consolidation. It broke out right here. It felled that 50%, like I was just talking about. So it came down, felled that 50%. If it stalls right there, that's when you buy. But if there was enough meat on the bone, you could have sold here, bought there. There's probably not in a 1 minute chart, but the point is right here, that's when you buy. You buy into that for a follow through of all the way up to this point right now. I'm just showing you guys on the 1 minute chart. So obviously your pip production is going to be a lot lower than if you were looking at it like on the 1 hour or the day chart or whatever, right? But the same rules apply. I look at it the 1 minute because it just shows us a lot more examples, right, of how it works, of how price action works. All right, so we got this right here, comes back down, touches that, and you could say on the 5 minute right here that that's our breakdown, touches that, and it should continue to go up. But then right here, it fells. So this is where you get that fell point. As soon as it crosses over here, that's when that strategy fells, right? Or that's when that first retracement of the pullback fells. Now, one of the things that we were looking at today was on a major breakout. And so I'm going to look at that to kind of show you guys that. I'm going to fast forward to where that happened right here. Okay. Right here is where it happened. You got this consolidation. You got this consolidation right here. And then you get this boom, this big old candle. Now, normally you get that big candle, I would be smacking that sell button like we just talked about for retracement back to here. But it also did what? It felled that 50%. So because it felled, this is the other thing, is if it doesn't pan out, get out. And this is the rule with playing that first retracement, that if it doesn't work out, get out. And you're going to have to get out quickly because generally speaking, off of a breakout, it's going to move fast. And so if it doesn't pan out, get out, right? Just kind of keep that in the back of your mind. Doesn't pan out, get out, right? So if it's a breakout, doesn't pan out, then get out. So here it doesn't cross that 50%, right? And so if you were into any sells right here, you would get out, and then I would try to flip into some buys because it failed that to get that 50%, meaning that it's most likely going to move higher. Okay. So then we know that from this morning that it actually does move higher. Here's the next action point, right? And so if you're riding this, this is your next action point right here. This is where it tells you to get in, get out, or to sit on your hands. And I'm going to show you guys that for a second. So if it ignores the action point, so if it goes past this action point, this next candle just shoots past this action point, that tells you that you need to hold. If this next candle doesn't, ignore that action point. If it doesn't ignore the action point, comes up here and stalls, that's when you get out, right? So this candle is very important to watch as to tell you what your next action is going to be. So we got this, and then that, it came up here and it probably sold. So for me, I would have gotten out right here and would have, not here, but I would have bought into here and made just a quick, 10, 11 pips. Then you look for the next pullback. So the strategy continues. You look for that next pullback to get in, right? And so it shoots up right here. So now we're looking for that next pullback to get in. So it didn't happen yet, doesn't happen yet. There it happens, but again, the 50% rule, right? If this crossed over the 50%, I would have thought, you know what, it's probably going to retrace all the way back down to here. But if it fails to cross over that 50%, depending on what where the body closes of the next candle, I probably would buy right back in to here for another move higher. So that 50% of that candle is pretty important. So let's see what happens. So, well, you would not think that that's going to happen. That's for sure. You did not think that that next candle is just going to shoot up, but it does sometimes. But you don't think it's just going to give you all of a sudden it's going to shoot up 20 pips in one candle in 1 minute. To me, that's an abnormal candle. And whenever I see an abnormal candle, I usually fade it, right? I'm not going to fade it because my rule in my trading says that if I don't have any action points over here or support and resistance to see where my next action point is, I don't know. And so I just kind of sit on my hands and wait. And I use a different technique to gobble up profits we're not going to talk about tonight. Okay. So we're waiting. And then boom, right here is where you could have gotten out once you start seeing that reversal point right here where this bar actually closed lower than this bar. That's your reversal. Again, if it fails to get that 50%, you could buy back in. If it crosses that 50% right there, then you start moving into a Fibonacci retracement. Now let's jump back over to this real quick, and we'll talk about false breaks. So let's talk about a false break real fast. We've all seen them. We've all participated in them. They're not fun when you're playing a breakout, but you can actually make some money on a false break. So a false break rule says this. Number one, if it's a fake out on a breakout, get out, right? So if you're in the wrong direction and if it breaks out and then all of a sudden it fakes out, then you need to get out. And we'll look at what that means. Look for exhaustion bars. Okay. I think we just saw one in the chart. We'll go back and look at that. Look for an exhaustion bar. An exhaustion bar is basically if you're in 3 price cycles deep, so it's moving up 3 price cycles against you. And then all of a sudden you get a big old candle that's 2 to 3 times the size of these candles or even that move. This is kind of a last ditch effort, or what we call an exhaustion bar, where it's reaching and then usually it's followed by a smack down and this bar becomes a huge wick. Right? So you get a huge wick on top. That's an exhaustion bar. That tells you that it's a false break. It's also an exhaustion bar, and you should fade that. And another way for fading, another terminology for fading is basically you're selling off you're going against the direction of that price movement. Right? That's when you're fading. You're fading that move because it's at the end of an expansion move. And then you get that last ditch effort, right? And so that's what I would call a false break. When you see that last ditch effort that moves higher and you're already in what we call an overextended market, I would definitely fade that and come back down. And then that always turns into a fib. So oftentimes I say fib that, right? You got to fib that. Let's fib that, right? And so we'll get into that. That's the next strategy. So you look for that exhaustion bar at the end of an overextended market. And then that's when you get into it's a false break, right? It's just, it extends that, fade it, come back the other way, right? So your breakout candles, you're looking to build into the direction. Your false break, you're looking to counter trade that because you don't believe that it has enough movement to push it in that direction because it's already moved that way and you believe it's going to come back the other way, right? So the weak wicked wicks, right? Say that 5 times fast. That's what we're looking for. We're looking for the weak wicked wicks that just boom on you and they just wick to the top side or the downside and then they come back, right? So that's what we call a weak wicked wick. And then, know when it does find support, know where that support is, going back to the action points that we talked about. Where are your action points? Know where it will find support, know how far down it's going to run, or when you get into that trade, know when to get out, basically is what I'm saying. And we'll go ahead. And then again, that 50% rule, that if it does come down and goes greater than that 50%, so if it wicks past the 50% here, there's a good indication that obviously you have pressure coming into that market that's just going to smack it back the other way, right? And so if it fails to give you this huge wick and this huge candle, fails to go 50%, then it's not an exhaustion bar. It could see a continuation of a climb higher, right? And so that's kind of like a rule of thumb, is that 50% rule, right? And so that's kind of what I adhere to and I look for. All right. So fake out, breakout, get out, look for that exhaustion bar at the end of a move in that same direction. So if it's an overextended move, then you get the last exhaustion bar. That's when you counter that and look for that 50% move. If that 50% move doesn't happen, then that's when you get out. That's when this strategy breaks down. That's when false breaks are no longer a false break. It's a continuation of that move, right? And so you got to identify when this strategy breaks down, just as well as how often you can use it. Okay. All right. Okay, I think I just drew that. So let's take a look real quick back to the chart. This is honestly a classic example of an exhaustion bar. Right here comes up, you get the big wick. Right here, it's already an overextended market. You see that it's ran up a ton. You're feeling like, okay, at any point it should turn, it should go back down. And then all of a sudden you get this big old candle that just pops out of nowhere and it runs up, 20 pips. Well, I'm fading that. I am just selling the crap out of this for a 50% move. So I'm selling this right here for a 50% move, and it came back down, stalled at that point. So this is your action point. This is your new action point right here. Because it stalls at that action point, that's a really, really good indication that it's probably not going to move higher, right? And it particularly came down here and stalled here and turned blue. What we're looking for this next candle is exactly what happened. You look for a continuation of this next candle to be blue, and it breaks the low of that green. Breaks the low of that green. Guess what? That is your confirmation that this was in fact a false break, an exhaustion bar with an opportunity to sell. And we're just going to go into this really quick. This is what I do. I sell this and I wait. This is my exit strategy. I just kind of turn this into a ride the wave situation where I'm selling right there and I wait until the next candle, which would be this candle right here, closes higher than the subsequent candle. So that's where my exit would be. So on this candle right here, I would get out, right? And then I would look to get back in, but would look to get back in on looking at the Fibonacci rules. And I want to just go over those real quick. So we'll go back to this. And the last strategy that I companion all these others with, so, you got the breakout, the false break, and then the last thing is the Fibonacci retracement. Every single platform gives you a tool called the Fibonacci replacement. Here are the rules for the Fibonacci retracement rule. You got to find the trend, obviously. You got to find the trend no matter what time frame that's on. You got to find what you want to retrace. You got to measure it body to body. That's important, right? You got to measure it body to body, not wick to wick, not candle, body to body. And then again, that 50% rule pops up. Truthfully, 50% is not part of the true Fibonacci, but it is the 50. It's kind of like that 50%. Does it have enough pressure? Is the pressure mounting? Are the sellers coming in to push it lower, or can they break that 50% of that fib, right? And the last thing is you never want to draw that where that you're taking. You never want to draw the Fibonacci rules with a fine line. You always draw it with an area. This is an area, and not where it could hit. A lot of times it does. So you look at support and resistance with that area, and that's where it's going to probably run down to, is that next support and resistance area. And then lastly is you don't always want to rely on one piece of information. So you don't just rely on drawing a fib and saying, okay, it's supposed to do this because of the Fibonacci. You need to have a good trader will often have 2, 3, 4, maybe even 5 pieces of information that helps to support their theory of what they think is going to happen, right? So I think that it is going to move lower. Well, what's giving you that information? You companion that with a lot of things. You companion that with maybe a chart pattern, a trend, a support and resistance area, maybe wick pressure that's coming in, and then also Fibonacci, right? Fibonacci is just a tool, not the tool, right? And so that's the same thing with just about anything, any rule of thumb. You try to grab as much supporting evidence that you can grab to support your decision as to why you're doing this. And then you take the highest probability of the next move. If the highest probability is X, then you should trade that. And if it doesn't pan out, get out. And then always have a plan B. I always have a plan B. I think it's going to do this, but if it doesn't, then it's probably going to do this, right? And so by having a plan B in place helps you to understand that if my first theory fails, then I can execute on this one and still find opportunity in the market. All right. So the Fibonacci retracement strategy, it's not something that I'm going to draw on. It's easier to look at the chart. So we're just going to jump over here and look at the chart. So if you look over here on the 1 minute chart, what you would do is you would find your Fibonacci retracement tool. And this is right here. It's this one, hover over it. And again, you draw the body to body. So it moved up. If it comes all the way back down, it has moved 100%. Okay. Again, I could spend an hour on Fibonacci's. I don't draw it on my chart because I've seen them so many times. I kind of know the areas, and I kind of know, hey, if it crosses 50%. So it's always, it's kind of interesting and kind of funny, is like not in ha, but funny as that it also correlates with support and resistance areas, right? That it comes down here, touches this 32% and says, nope, I'm going to come back up here, touches the 28. So basically what a Fibonacci retracement says, that if it crosses this line, it's a high probability it's going to come down and touch this line. If it crosses this line, it's a high probability for this. This is a high probability, and this is a high probability that it touches that, right? Or it comes down and gets you 100% retracement. Now, there is another one that we don't show, most charts don't show, and it's like 70 something, and I'm not familiar with the exact terminology, but it's right here-ish area, that if it crosses that, it's definitely going to come down to 100%. And so by knowing that there's this one here, you could see that the market could turn here as well, right? You get a turn there as opposed to coming all the way down to 100%. Thank you, Joseph. 78.6. Exactly. So, but it also kind of correlates with a action point. So that's what I kind of look at as the action point. A lot of like MT4, things like that, they don't really show you that 78.6, but I always look at it and kind of identify that because it still is an area where the market could turn and go back. So just by knowing that is also good information to have. All right. So, so in here, that's your Fibonacci retracement. And so basically once it crosses and gives me this information right here, once it gives me this information that it's a confirmation that we're now moving down, then I kind of move into that fib, right? Particularly if there is no other information to the left, like if we're in what we call an outside range, or it's trading outside of this range, then you don't have support and resistance to rely on. You have to rely on the fib levels, right? And so when I say fib that's what I mean. So let's look at this really quick. So it came down and it crossed that. So if it crosses that, it should continue to go down. If it crosses this action point, it'll probably go up and test the high, right? But if it fails to cross this right here, you could probably get back into sells. And so right here, we got out, remember, because we got out, wrote it down, got out. So we could get back in on the test of this level right here and get back into a sell there, and then ride that down again, back down to doing the same thing, waiting for a confirmation or a body closes higher than the subsequent candles. So looking for a confirmation of that reverse. And so if you got in here, you would hold on, you would hold on, you would hold on. And again, looking at this action point, because here's an action point right here. This is an action point, but you see how these candles are ignoring that and continuing to go on. So if it ignores the action point, you hold your trades. You don't get out. You hold your trades because it didn't stall here, didn't touch, it went past it. Okay. And then and then right here is where you could have gotten out right here and made, 20 pips ish right there. Make 20 pips, get out. Okay. And then wash, rinse, repeat. Do it again. If it comes up, fails to break this, you could get back in. So if goes back up, fails to break, fails to break this candle, you could get back in. I probably would have gotten back in maybe right here, not on that wick, because it's hard to get in on wicks, it's hard. And as a scalper, you got to be really quick. So you could get right back in right here if it fails to break that. So if it fails to break that, you know that it's going to push lower, and we're going to see if it can't cross this. And this is what I love is like when it plays right on that 61%, 61.8 right there. I love taking this risk because if it does break it, it could give you that full 100% retracement. Right. And so I love getting in, and I probably would buy in if it continued to go up all the way up to that 50% line right there. So I would get in, put a layer on or a stack of trades on, ride this down, and again, write it down until we get to the next action point, or the yellow or a green candle gives me that reversal signal that it's going to move up, right? And so that doesn't happen until right here. And I'd probably get out right there. So again, you could gobble up another 20 pips right there. That's your Fibonacci retracement, right? And again, you don't do that. It was just like a classic price action day today of seeing a breakout, a false break, and a fib level all at the same time. And you do get that often. You get that often, but not where you're seeing a 60 pip run. You don't get that often on a 1 minute chart, but you do get that like over here, right? And so this expansion, you fib that, guess what? You got 100% retracement over there. Right here, same thing. It moves higher. You get the breakout followed by, and we'll zoom in really quick. You get a breakout followed get a breakout, and then maybe a false break happens right here where it's kind of testing. You get a false break on the backside, testing, get in right here, and then you fib it, right? Breakout, fib it. Now, the last thing we're going to talk about is pretty quick, is basically everything that I talked about tonight. Don't take my word for it, test it. Test it yourself. And that's the next thing that we're going to talk about, is you got to back test. Back testing is one of the most important aspects of developing any trading system, right? If created and interpreted properly, it can really, really help you guys to optimize and improve all of your techniques, your strategies, anything. And so back testing I highly, highly, highly recommend it. I never take a trader's word for it, that this is how you should do one thing. Go back and back test. And so it's really, really simple, right? If you have TradingView is a great platform to do that. It's built for that. But if you don't, just go back and back test. See how many times, look for 10, 20, 100 times that this, what we talked about, where you get the breakout, the false break, the continuation, the exhaustion bar, followed by a Fibonacci. Look for how many times that happens. And if you can back test anything and figure out that 60, 70, 80% of the time it does this, that's a high probability trade setup. Hands down, that's a high probability trade setup, right? For me, just totally one of the things that I look for is abnormal candles, right? I look for abnormal candles that are 2 to 3 times the size of subsequent candles. Now, obviously there's one there. Let's see if we can find one, and then back test it, figure out right here. So here is an abnormal candle where it breaks market structure. You get, these candles right here, is a 3-pip candle. This is a 2-pip. And I don't even measure on 3-pip candle. And then all of a sudden you got a 6-pip candle. So it's 2 to 3 times the size of all the other candles. I tend to say it's a high probability trade setup for me, as long as it doesn't break out of consolidation. If it's a breakout candle, that negates everything that I'm talking about. A breakout candle, I'm talking about just a abnormal candle inside a consolidation or inside of an area, a trading's area. I usually will fade this and sell it for the 50% rule, or 100% if my action point just goes right past there. And then just like a tiny little, you could call it a fib. I don't really know. It's not necessarily a fib. It's just an abnormal candle, high probability trade setup. It's one of the ones that I use often in my trading because it happens all the time. Right. And so I look for that. And so back test that, find something that somebody does, back test it. How many times can I go backwards and find an abnormal candle that, guess what? It does that. And if it does that, like I said, 60, 70% of the time you have a high probability trade setup. Again, right here, boom, abnormal candle. This is an abnormal candle followed by another abnormal candle. So I would kind of group these two together for a 50% pullback. And you get that. Again, this is not an abnormal candle because it created it right here. So the first one is your abnormal candle. All right. So there's a lot of little things, and that's why backtesting is so important. Don't take my word for it. Do the work. If you do the work, it'll increase your confidence level in your theories. Be confident that your theories will work out by backtesting. Backtesting will give you that confidence. Okay. And then I know we kind of ran over, but I wanted to kind of keep this about an hour. But let's just jump into to anybody have any questions? I kind of went through it a little quickly. But if anybody has any questions, I'd love to answer your questions right now. See what you guys got. If not, then either I did a really bad job, you're all confused, or I did a good job and you don't have any questions. Hopefully it's the latter. Anybody have any questions? Joseph, you did a great job. Does anybody have any questions at all? If not, then I'll let you guys get to bed. Appreciate you guys being here with us tonight. I love it. I love trading. Trading is my passion. It's a lot of fun. I don't love trading all day, every day. I love getting in, getting out, and getting done. That's why I love scalping, right? I tend to try to trade for about an hour a day, and then I'm done, right? So, again, oh yeah, guys, those of you guys who are watching this on YouTube, if you like this video, want more videos like this, please, again, like, subscribe, you know the drill, all that kind of stuff. But most importantly, join our Discord server. Our Discord server is kind of like our community of traders, where we bring you guys the trading leagues, the 5 to 50 challenges, and all the other challenges. Our whole goal here is to help you to become a better trader, consistent trader, and then get into those funded accounts, because it's not likely that retail traders can have, I have $100,000 lying around in the bank, I'm just going to go trade it, or $200,000 lying around in the bank, I'm just going to go trade it. That's not likely. And so we need to have those companies or those prop firms or whatever hedge funds or whatever, to be able to give us that money so that we can make more money. And Trade the Fund is just aligning those people with the people that have the money with the people that know how to trade, and we're teaching them and hopefully giving them that skill set, right? All right, guys. We will, for those of you guys who are with us tonight, we'll see you in the AM. Get some plenty of sleep. Drink lots of water, because we're going to hit it hard tomorrow. All right. Thank you, guys. And we'll end it there.